cost of the milk is easy to relate to the sale. On the other hand, some expenses are not directly tied to the sale. Those expenses are better identified with a period of time rather than a sales transaction. Okay, well, that's just what I mentioned. On the flip side, because of the matching principle, businesses often record expenses before they make payment for that expense. Sometimes we don't even know the expenses after we've incurred them. Utilities are a prime example. Let's say a company has a calendar year end, in other words, their year end ends on December 31st. They probably don't even know what the utilities bill is until sometime in January. And so they will record that expense as of year end. It's through an adjusting entry. We'll see those later, even though they don't pay it until a later time. They'll also, for other types of expenses, pay for expense items before the expense has actually been incurred. There are two fairly common types of expenses that we must pay in advance. Insurance is one of those, and I know there's another one. Rent. Rent is the other one. So when you pay insurance, you have to pay for that premium in advance of the policy year. And so you will debit a prepaid insurance account or a prepaid insurance expense account. Don't be fooled by that, because I'm going to try to fool you on it, try to trip you up to make sure you know your stuff. When you make that premium payment, you will debit prepaid insurance expense, prepaid insurance, depending on what account title the company uses. And that represents an asset rather than expense. Even though it says prepaid insurance expense, that prepaid turns it into an asset. Because that, until the policy year begins, that really all of that prepaid insurance expense pertains to the future. So it represents probable future benefits. Once that policy year begins, then we would, of course, have to expense a portion of that prepaid insurance expense. And so we would need entries, at least at the year end, to charge or debit insurance expense for the portion that's been used, and to credit prepaid insurance expense for the portion that has been used. There are other examples of these two that we will look at in class and that we'll run into from time to time. Revenues and cash receipts are usually not the same, nor are expenses and cash payments the same for a given period. Financial statements prepared according to GAAP apply the accrual basis of recording revenues and expenses, which contrasts with the cash basis. And here's a summary of the differences between these. Under the cash basis, revenue is recorded when the cash is received, regardless of when the right to receive it occurs. That is, regardless of whether the company has a right to keep that money, whether or not it has done what it needs to have earned that revenue. And expenses are recorded when payment is made, that is, when the cash goes out, regardless of when the obligation occurs or whether or not the company is actually the company has consumed or used up that expense item. Under the accrual basis, revenue is recorded when it's earned, that is, when the seller has, as we've seen, done what is required to claim a right to that revenue. And also, of course, we're assuming all along here that the revenue is measurable. Expenses are recorded when they are incurred. That's not a common term that we use. Earned we understand better, but incurred means that we have received a benefit and have consumed it. The company has used up those supplies. It has received the benefit, let's say, of the salary of the labor that our salaried and hourly people have provided, that it has received the benefits of the advertising or utilities and that sort of thing. So expenses are recorded when they are incurred, that is, when the benefit has been enjoyed or consumed, even if we haven't paid out the cash yet. So that's under the accrual basis. Notice revenue is recorded when earned, even if we haven't received the cash. Expenses are recorded when incurred, even if we haven't paid out the cash. We have now to look at these remaining concepts here. Let's see, we looked at the recognition principles. now of revenue recognition and expense recognition. Now we look at measurement principles. Measurement concerns the dollar amounts that we assign to a given transaction. And GAAP currently uses various measures for recording changes to the financial statement elements, that is, in measuring these elements. Thus, we use the term mixed attribute to describe our measurement model. And there are 5 measurements in use and reflected, therefore, in the financial statements. The first is historical cost. Assets are recorded at their original cost, which is the basis for all subsequent transactions. For instance, we will record our inventory purchases at cost, and then later on, when we sell that inventory, and it's time to transfer the cost of an inventory item, like that bag of Doritos, from inventory to an asset account to expense, we will refer back to the cost of that item, as opposed to the selling price, as opposed to the what we might call fair market value or replacement cost. Historical cost, really, as it says here, is the dominant measurement attribute reflected in the balance sheet. By the way, the same thing would apply for fixed assets. You know, when we buy a piece of equipment, we will record that at its cost, that is, what we gave up in exchange for it. And that will become the basis for all future transactions, including depreciation expense. And of course, later on, when we sell that asset, we will have to refer back to original cost, as well as the accumulated depreciation, to figure, as well as the selling price, to figure out whether we have a gain or loss on that transaction. Historical cost is the predominant measurement attribute we see in the balance sheet, and therefore what is reflected in our income statement. Net realizable value is the amount the firm expects to realize upon disposition of the asset. Disposition of an asset. Accounts receivable are reported at net realizable value. In other words, that net accounts receivable, gross accounts receivable less the allowance for doubtful accounts, that net amount represents what we actually expect to collect in cash from our customers. Current cost is the amount the firm would have to pay for an asset if they were to buy it currently or to make it. Now notice, if prices have changed since we bought inventory or supplies, then the current cost of inventory is going to be different than the historical cost. Inventory may sometimes be recorded below historical cost, and current cost may come into play when making this adjustment. We will deal with this when we talk about inventory, because for the most part we'll focus on the historical cost of the inventory, except at year end, when we will have to make a comparison of cost to what's called net realizable value. But we'll deal with that later. Present value is the discounted present value of future cash flows associated with an asset or liability. This attribute applies mainly to valuation of long-term debt. And fair value is becoming increasingly important in valuing long-term financial assets such as stocks and bonds being held as investments by a company. The fair value option term that's used refers to the choice that firms may have with respect to valuing financial assets or liabilities at their fair market values rather than historical cost. The disclosure principle calls for revealing info that will be useful in decision making by informed users. The notes to financial statements at the end of the end of the financial statements themselves provide essential information. They're just not nice to have. They are an essential part of the financial statements. For the most part, when it comes to disclosure priorities, that is, the most prominent information is going to be displayed on the face of the financial statements themselves, including any parenthetical comments that go along with the statements. Next come the notes to financial statements, which describe several things here. First of all, the accounting policies the firm follows in recording and presenting data in the statements. That is, things such as inventory valuation, whether the company uses FIFO, LIFO, or average costing, depreciation methods, valuation methods, say, for long-term investments, that is, whether the company has exercised the fair value option in presenting that information. So the footnotes to financial statements are essential to understanding and interpreting the statements themselves. They also provide information on contractual arrangements that help better understand the firm's obligations, other items of significance in understanding the statements, and third, supplemental schedules that provide more details about items included in the statements. For instance, you would find on the balance sheet itself the total bonds that a company has out, so long-term debt. But back in the supplemental schedules, you'll see the detail of that to find out when, not just that you've got long-term debt, which means it's going to be maturing in beyond 1 year, but if the company has different issues of bonds, for instance, making up that long-term debt, you would see the amounts, you would see the due dates, you would see interest rates and things like that that would help the financial statement users better understand the statements themselves. And that's all for now.